Hello and welcome to Money Talk. I'm Kim Parlee. It is great to have you with us tonight. If you turn on the news, there's just no escaping the latest legal drama engulfing Donald Trump's presidency. On top of that, we have a trade war and an impending U.S. election that could see Democrats taking over the House. Could all of this turmoil finally put an end to the longest bull market in history, which was just clocked in today? Joining me now is Marko Papic. He is Chief Geopolitical Strategist at BCA Research, and he joins us in person. It is great to have you here.
It's my pleasure, Kim. Thank you for having me.
Absolutely, our pleasure. I want to start with the thing that right now makes no sense to many people. Okay, you are a geopolitical strategist, and I mean, and from geopolitically speaking, I don't think we've had more news or more craziness going on in the world everywhere.
That's right.
And we are right now, I think, as I mentioned, we clocked the longest bull market run in history. So what's the disconnect? Why do you not think the markets are concerned with, and let's just start with the first one, Michael Cohen, Paul Manafort, and Donald Trump?
Well, I think ultimately we all have to go back to what drives bull markets, and it's earnings. And so when there is geopolitical events out there, a lot of time I think investors overstate their impact on actual fundamentals. In the case of what's going on with the Mueller investigation, it's a great example of something that's interesting. It's a human interest story. It's obviously politically relevant. It's important for voters. But for markets, it just doesn't make that much difference. And we know this from the previous 3 times we've had close calls with impeachment. 2 of those happened during the most roaring bull markets in U.S. history. 1920s, the Teapot Dome scandal that almost impeached President Harding, but he died before he could get impeached. And of course, Bill Clinton with the Lewinsky scandal. Those 2 happened during the largest bull markets in U.S. history.
What about trade wars? Because I mean, yes, I hear what you're saying. I mean, if you were to take it to its most extreme outcome, let's just take the states before we get to trade one more time. Let's say Donald Trump did get impeached. And again, no one's saying that at this point, but let's just say that he does. You've got a vice president coming in who's probably going to just continue with the same kind of policies.
Well, that's right. And one thing we always emphasize to our clients is that on the political front, there's 3 political tailwinds to equities. 1 is deregulatory agenda. Yeah. 2 are the tax cuts. 3 is the fiscal stimulus that was passed in January, the sort of 2-year appropriation bill. None of those will be affected by impeachment. Mike Pence would continue all those policies. And in fact, I would even go further. I would say the midterm and victory by the Democrats in the House would also not affect any of those 3.
Why? Just take us through it.
Right, absolutely. Well, first of all, regulation is the prerogative of the U.S. executive. So winning the House does not give the Democrats control over the regulatory policy of the U.S. 2, tax cuts. How are you going to roll them back? You need a veto-proof majority in both houses of Congress, which is not something that anyone's forecasting the Democrats can win.
Right.
And then finally, fiscal stimulus. Are the Democrats really going to be the party of austerity? That just doesn't jive with history. And so I would actually argue that even winning the midterms would not change much these policy tailwinds behind the bull market.
Okay, let's talk trade, because I think trade is something that is going to, and obviously you've got a president in place now that believes very much about playing hardball when it comes to trade. And I've heard differing things about NAFTA as an example. There could be a handshake deal now with Mexico. Something could be coming with Canada. But China, I mean, when does this actually, because, we see little blips in the market when tariffs get announced, and then it just pops back up.
Well, we think that this is going to continue to be something that investors should be alarmed about. And that's because President Trump does have a high conviction view that China is the problem. He seems to have gone away from punishing, EU and Canada and Mexico. There has been a shift in rhetoric, but on China, we are currently in a process where the $200 billion worth of imports, the tariffs on those $200 billion, we're in a process where companies are basically submitting their view on that to the U.S. Trade Representative. So literally today, this is happening. This consultation process ends on August 30th. And that means by September, we could have another $200 billion worth of Chinese imports tariffed. So I think the key for investors to understand is there's few constraints on President Trump in imposing those tariffs. Not political, not economic, not financial.
That's not good. It's not good for the market, or so it's not good for trade. Does that ever translate into the markets, though?
Well, you could argue that it's already impacted the market. You could argue counterfactually that the market would be higher today if the consensus view, which was that there would be a hand deal, would actually happen. And let me just remind you, there was a handshake deal on May 20th. The U.S. and China actually issued a joint statement talking about reducing the trade deficit. And Trump after 4 days of criticism from his party, from Democrats, from everyone, he actually reneged on that deal. And that's something that really worries me, because since that deal failed, China has depreciated the renminbi. In fact, the June depreciation was the largest single-month depreciation of the Chinese currency since the 1994 epic devaluation, which means that they are retaliating. That's not a shot across the bow. It's shot into the bow of the United States. And that suggests that China is also retaliating and playing tough on this issue.
What about, I mean, so let's get into the currency then. I mean, you know, we know that he has accused China very vocally of manipulating its currency. And then here you talk about the fact they've really kind of...
They have.
Yeah. So what comes of this? I mean, is this more fuel in the fire of the issues with China?
Well, there is, of course, how Trump is going to retaliate to that. That's an interesting question. Obviously, it will motivate him to be more aggressive.
Yeah.
I think there's another issue that investors are not really focusing much on right now. We know that China is stimulating. They've moved away from some of their structural reforms. They've changed some of their macroprudential oversight. And some of our clients are interested in being more open to global risk assets, to emerging markets in that scenario. But if China is both doing stimulus and depreciating currency, then this is going to be a lot different from the 2015-2016 stimulative effort, where they basically capped depreciation of the renminbi and stimulated. That was positive for commodities. That was positive for risk assets globally. If they're stimulating and also devaluing the currency, that's not going to be that great for emerging markets, commodity producers, and global risk assets, because it means they're exporting deflation still through the currency mechanism. And that's why it's very important that they've reached for the currency lever, not just from geopolitical perspective, but also economic.
So what happens when you export deflation and you've got central banks that are, you know, not doing a lot anyway, kind of thing? I mean, there's no real inflation to speak of. So when you actually export deflation, I mean, that's concerning.
Well, you're adding deflation to an already, deflationary world. Yeah. Now, of course, in the U.S., we're starting to see, green shoots of inflation, and this is the big danger. In the U.S., you have the Fed that's responding to domestic conditions, which are very, very robust. You have supply constraints being hit. You have inflationary pressures. And the Fed's not going to steer clear from that. On the other hand, China is exporting deflation through the currency. This is going to further basically stretch the U.S. economy away from the global economy. It's going to allow the U.S. to outperform even further. The dollar's going to go up. And that's very bad for global risk assets in emerging markets.
Good. I want to kind of bring this all back down to what this all means for the investor, what they should be watching for. You did talk about China. They're devaluing the currency. They're being stimulative. But you're telling me in the break they're not stimulative enough to kind of kick off global growth.
Right. Well, and that's what they did in 2015. At the end of 2015, 2016, what launched 24 months of global risk assets outperforming the U.S., so we're talking emerging markets, cyclicals, commodities, was really that stimulus that China did at the end of 2015, 2016. They surged credit massively. I mean, it was incredible. And M3 shot through the roof, credit shot through the roof, and we don't see them doing that again, first of all. And second of all, complementing fiscal stimulus or credit stimulus with currency depreciation in net terms is, not that great for the rest of the world.
Let me ask you, what is this, and you were talking about the fact emerging markets and commodities, this may not be the best as well. Canada obviously very dependent on oil in terms of our outlook. So what's your outlook for oil?
So here's where it gets weird, if I can say that.
Yeah.
Normally in this environment, obviously oil prices would go down. And that would actually be a natural balancing mechanism that would then stimulate consumers. It would stimulate economic activity. It would be good for the economy. But we actually have a very bullish view on oil. And it has nothing to do with global growth. I mean, demand obviously is an input into our forecast. But because of supply constraints and because of geopolitical reasons, the Iran sanctions that are going to come into force on November 4th, the situation in Venezuela, which is actually getting more dire, we can see oil prices next year going north of 90 very, very quickly.
Really?
So, long way to answer your question about Canada, but this is actually a bigger issue because normally where global growth is not doing great, when emerging markets are in trouble, a lower oil price helps everyone around. We're not going to get that this time around. So if China's not going to stimulate enough, if the U.S. Fed, which is really the central bank of the world, is tightening policy and interest rates are going to 3% and on, and you have an oil shock to the upside, that's a pretty pernicious environment, not just for emerging markets. It's pernicious for everybody.
Yeah, I guess so for
except for Canada.
Yeah.
I mean, Canada is lucky in that, unlike Australia, it's really tethered to the U.S. economy, which is the bright spot in all of this. And so we can see the CAD being flat versus the dollar and being one of the best performing commodity currencies if you were going to find one. So actually, this story is not necessarily bad for Canada because you have two things going for Canada right now. The U.S. economy is outperforming the rest of the world, not China. And second of all, oil prices could go up.
What is going to, I mean, is there anything you watch to say, okay, this is where I see things moving? I know, the very definition of a black swan means you don't know what's coming. So I can't say, what do you think is a black swan? But what do you think are some kind of exogenous events, to use the industry terms of what could come in and rattle things up a little bit?
Well, I think, first of all, what's going on with Turkey is seen as an idiosyncratic issue. I think everything is really tied together. The dollar appreciating, interest rates going up. We're further down the tightening cycle with the Fed. I think the one big thing that we might be missing is that everyone's been looking for bubbles. We're late stage cycle. Where's the bubble? Is it in corporate bonds? It is in tech. It might be in emerging markets, and we might be facing actually a pretty pernicious downtrend in emerging markets, a bloodbath, if I can use that word.
So if you see something happen in emerging markets, it's that transmission to take other things.
I mean, look, Turkey's not a big country. We get that, but neither was Thailand, neither was Greece. So that's what I would be worried about.
Let me ask you to bring it back to what I wanted to start with, which is, again, what does this mean at the end of the day for investors? I mean, we're in, again, this super long bull market.
Right.
Super long also means old, which means a lot of people thinking it could end sometime soon. But again, earnings looking good. The geopolitical you just mapped out. What should investors be doing?
So the risks are abroad, not in the U.S. And I think that's driven some of the more domestically focused and also some of the FANGs that really don't have much exposure. Apple obviously does. But what's basically going on is that the U.S. historically, geopolitically, militarily, economically, really benefits in a global crisis. I mean, that's the message that we know from the last 100 years. And what's going on right now, these are risks outside of the U.S. They may eventually enter the U.S. economy and the U.S. markets through the transmission mechanism, which is the dollar, if the dollar continues to appreciate. That will force the Fed to back off at some point, maybe in as early as late of this year, maybe early next year. If that happens, the bull market's not going to end. If the Fed backs off, it's going to be like 1998, 99, and we're going to have another 12, 24 months of overshoot.
I've only got 15 seconds, but the one thing it seems like everything we talk about seems to all come back to like a bull market, and is that just because that's the mentality right now?
No, I think it's because the Fed could back off and actually, create another 12 months of an overshoot. Now, the pernicious side, if you want the bearish view, is you could have a recession next year. Why? Because the problems we described, and an oil shock, and the Fed overshooting on its interest rates.
If it's enough to tip things over.
If it's enough, that could tip. But that wouldn't be our base case.
Marko, always a pleasure. We come back and see us in person again?
Absolutely.
All right.
It's a pleasure. Thank you so much.
Marko Papic, he's Chief Geopolitical Strategist at BCA Research.